Financial shockwaves rippled across the country this week following two of the biggest bank failures in American history. Silicon Valley Bank and Signature Bank were shut down by regulators last weekend. On Monday, President Biden, trying to prevent more failures, took the unusual step of promising that all depositors at those collapsed banks would be made whole. Treasury Secretary Janet Yellen also addressed the banking concerns this week when she testified before Congress.
Our banking system is sound. Americans can feel confident that their deposits will be there when they need them.
But fears do remain. On Thursday, some of the nation's biggest lenders gave $30 billion to a smaller rival, First Republic Bank, trying to assure its survival. Here in Washington, lawmakers on both sides of the aisle want to know what went wrong and why bank management and their regulators were caught so flat-footed, especially following the 2008 financial crisis.
We need to learn from what has just happened with these banks and go forward by tightening the regulations.
I think it'd be premature to start talking about solutions before we fully define the problem and ultimately get answers from the regulators about why they were asleep at the job.
So this economic unease, coupled with ongoing concerns about inflation, raised the stakes for a highly anticipated Federal Reserve meeting next week, where Chairman Jerome Powell is expected to announce the Fed's next move on interest rates. Joining me now to discuss all of this and more is Neil Irwin. He's the chief economic correspondent for Axios. And here with me in the studio, Finn Gomez is the political director for CBS News. Zolan Kano-Youngs covers the White House for the New York Times. And Kyla Toshi, she is an anchor and senior White House correspondent for CNBC. Welcome to all of you. Thanks so much for being here. Feeling bad I didn't wear green like everybody else did. Kyla, to you first. This week we saw two banks collapse, this very aggressive move by the federal government. We saw this injection of billions of dollars into another lender. All of this to calm the jitters, but the jitters do not seem to be calmed. Is it your sense that we are through the worst of this yet?
I think there's still a lot more to learn because we know what the government and what the private sector has done so far and what they have disclosed. But we got a very important data point this week from the Federal Reserve on Thursday, which is what its balance sheet looks like. How much money has the Fed had to give out to other undisclosed banks? That number was $153 billion. That's the highest on record, even higher than any single time during the global financial crisis back in 2008. So that tells you that there are a lot of banks we don't know about who have run to the arms of the Fed for low-cost capital because they're worried about their own companies. We won't know who those banks are for another 2 years. And even for the deal that 11 major U.S. banks did for First Republic, where they essentially handed over $30 billion in deposits, they only did that
Opened up $30 billion in checking accounts.
Well, some might say they just transferred back $30 billion in deposits the First Republic customers had very worriedly moved to their banks. And so it was just, it was a returned gift, so to speak. But that deal only lasts for about 120 days. We could see what happens to First Republic. Can it find a buyer? Is the bank's operation even worse after that time? Or is this situation over? Does the tide come back in? We still don't know, and there's a lot we're waiting to learn.
Neil Irwin, to you on this question. There has been some second guessing about this aggressive move that the administration and the Fed took to try to stop the bleeding here. What do you think? Did it seem appropriate to the moment?
Look, this time a week ago, they saw a profound risk of a systemic crisis, of run on deposits at banks around the nation. They decided it was better to do too much than too little in that situation, and that it was worth it to kind of take the risk off the table that your deposits, even over the federal limit of $250,000, might be at risk. Look, there's going to be a lot of picking over whether it was the right thing to do, whether, what the long-term costs are, how the long-term regulatory structure ought to change as a result. But the judgment that I think is not at all crazy and quite reasonable is that if we get in a real financial crisis where every bank is seeing mass withdrawals, that's a very bad situation to be in, would be very devastating for the U.S. economy going forward.
Indeed. Zolan, can I ask you, what is the White House's view of all of this? Do they think that their actions, certainly the president is out there championing it, saying, we got you covered, we're going to make sure this doesn't get worse. Do they think secretly behind closed doors that the worst is over?
Well, I mean, the president is out there saying that, but also emphasizing at this time accountability for banking executives. I think that definitely they feel that the actions this week were necessary, but to say that there's no anxiety, both politically and for the actual issue here we're talking about with the financial sector, I don't think we could say that. Look, politically, we have to understand the concern here. I think we have to take a step back and realize how this president has, what image he has projected over these past 2 years. One of the champion of the middle class. How many events have we seen recently where he's going and talking in front of unions as well, talking about bolstering the manufacturing industry? He often talks about the sanctity of labor as well. Now you also have that same president that was in his West Wing office watching what happened in 2008 when a bailout happened and it was met with backlash as well. That still haunts Washington today. So absolutely there's concern. I think you can still say two things can be true. I think they still are comfortable with the actions taken this week, but at the same time, politically as well going forward, there is concern in the administration.
Yeah. Finn, Zolan used the B word, and that is not the B word that the administration has been willing to say, that this was a quote-unquote bailout. Can you remind us why that is such a sensitive issue for this White House and particularly for this president?
Well, you used the word jitters, and I think that's exactly what that word, that's concerned that word would cause, I think, among the American public within the administration if they utilize that word. It harkens back to that 2008 global crisis that happened, that is still has that impact, that still has permeated throughout the political landscape. Now you're seeing it used rhetorically by Republicans, especially from the Senate side, but it's also being used by potential Republican presidential hopefuls, by presidential candidates who are saying that this is in fact a bailout. And I think it also could be a prelude to what may come as we continue forward into this presidential cycle.
There's also a question here too. I mean, remember what one of the political vulnerabilities was for this president. Even before this, it was also inflation for the past 2 years. Right. And how will the Fed's actions going forward impact how they're trying to tame a red-hot economy, try to tame inflation as well? How will this impact a decision in the weeks to come around raising interest rates? All of that also factors into sort of the concern and anxiety about the actions taken.
But there's a very real risk that the Fed continues to send mixed messages, because last weekend when they came to the rescue of Silicon Valley Bank and they took control of Signature Bank, they did so under the rationale that there was a systemic risk to the economy.
This was an emergency.
At the same time, they're trying to shore up confidence. They're saying this could spill over. And so it's a double-edged sword, and they run the risk of doing the same thing next week with their interest rate decision, because they have said inflation is persistent. It runs the risk of getting entrenched. We cannot stop now. If they stop, they're signaling to the markets and the economy and the broader American public that they're worried. That's like your parents getting worried and you as a kid saying, oh no, I wasn't scared until I saw you get scared.
Mom looks scared, watch out.
Exactly.
Neil Irwin, several Democrats, including Senator Elizabeth Warren, have argued that the 2018 rollbacks of some of the Dodd-Frank reforms that were put in place after the 2008 crisis, that those rollbacks were complicit in what went down this week. What is the evidence for that?
So look, in a narrow sense, I think the evidence is ambiguous that if those legal changes to the regulatory structure in 2018 hadn't happened, would we have avoided all of this? That said, the tone that has that enveloped Washington over bank regulation the last few years, it's unquestionable that it was in the direction of these mid-sized banks do not deserve the kind of scrutiny that the giant banks get. And so what that law that you're referencing did was said, you know, banks that have $200 billion, $240 billion in assets, they don't need to be treated the way a JP Morgan, a Citibank does. And so we're going to lower the level of scrutiny. And apart, again, from the specific question of whether, if that law hadn't been passed, whether Silicon Valley Bank would still be, operating, I think the open question is, was there a broader situation where regulators felt like they could not push hard and not really scrutinize and drop the hammer on banks that were taking inappropriate risks in the last couple of years?
Finn, we heard from Thune and from Elizabeth Warren at the top of the show two competing ideas of what Congress ought to or ought not do in response to this. What is your sense about, does Congress have a mandate? Is there enough of a majority of people in the House and the Senate to say, we need to act, and if so, what is it that they might do?
I think it depends on how worse this crisis gets. I think there is a sort of this collective field of populism right now, and I think that this plays into that. And I think it affects both parties politically. And if this crisis gets larger, if it gets bigger and has more of an impact like across the country, I think you could see some maneuvering on both sides to do something more. Maybe perhaps doing something for what the president called for today, and having more punitive measures for some of these senior executives who have run these banks, who've led in these banks into the crisis that we're seeing now, William.
Zolan, this point we've been making here is, as you were saying before, the president does want to seem like a middle-class champion, and this concern over calling this a bailout, and yet also wanting to keep the economy moving in the right direction. It's an incredibly complicated circumstance for him. It seems like he does, in some ways, could be caught between a very real rock and a hard place here.
I think that's true. And, talking about some of the progressive backlash on the Hill, one thing that I thought was interesting is, and I saw a couple members connected also immediately saying, look, these executives may have traded stocks, may have made a profit, but at the same time, Republicans continue to block a student loan plan that I'm sure that the president would love to be galvanizing his base off right now in the courts. So now you also have that happening right now, and that pressure on the White House too. It's an incredibly complicated balance that he has. I think it will probably factor into more of the events we've seen of him touting an infrastructure package, touting a CHIPS package as well. If we see in the weeks ahead or in the months ahead what many expect will be a potential re-election announcement, I think that you probably will see the administration double down on some of those events. Last summer, we did see a series of legislative achievements happen, and you would think that they would point to that to counter some of the criticism that might come from the past 2 weeks.
Right, I'm sure they wish that this banking crisis would simply go away and they could talk about the record, as you're saying.
And remember, that record, a lot of those benefits, it takes time for voters to feel.
It's not instant.
That's right. This, however, people see. People talk about immediately, people can feel immediately as well.
William, I think you're also going to see the administration trying to lean on the private sector very heavily. Earlier this week, the Treasury and the Fed brokered a deal with the 4 largest banks in the country. They had the 4 largest bank CEOs with them in person, and the message that sends is, we bailed you out 15 years ago, you're a lot stronger, you bail them out now. You bail out your peers. Right. They want to wash their hands of this. They've done what they feel like they can do, and now they want to lean on someone else to do it.
Neil Irwin, one last question to you on this. As Kayla was mentioning before, the Federal Reserve is meeting next week. A lot of pressure on them. They want to keep moving forward against inflation, but what they do next week could certainly be a signal as to what they really think about the severity of the crisis that we are in now. What do you expect from that meeting?
So the Fed likes to emphasize the idea of different tools for different tasks, meaning they raise interest rates to try and fight inflation. Meanwhile, they do all this emergency bank lending to try and prevent a financial crisis, prevent the banks from collapsing. In truth, those things are more intertwined than they really like to admit. And if they do raise rates next week, that's going to make things harder on banks. And if they back off, that might make the inflation situation harder. So it's a really no-win situation. I think they're probably going to go forward with that rate hike, but signal openness and flexibility, and that they might not do it again if things really do go south. Because the truth is, if this banking problem that happened over the last week spreads to the entire banking system, results in credit contraction, banks making less loans, making more stringent loans, that will cause an economic slowdown in a way that the Fed interest rate increases up to this point really haven't. So there is a possibility that we will see the disinflation, the economic slowdown they've been trying to engineer for a year now come about because of this banking slowdown. But the range of uncertainty is enormous at this particular moment.
All right, Neil Irwin, thank you so much for joining us.